one size does not fit
Yeah.
all. I've done plans for 60-year-olds where we've got them financially free by, 67. Now, granted, they had strong incomes, but everybody's situation is different, and you can do something to get yourself in a better situation than you are today. So please do not take these projections as gospel. Think about your own situation and focus on how you can get ahead.
Welcome to Checks and Balances, brought to you by Partners Life. I'm Michael Vincent. This is James Blair. And today, should you buy a house at 50?
We're back in your life.
We're back in your life.
Michael, great to be here. I love these episodes. Just me and my boy.
Hanging out, chatting. We're just two chatty bankers.
Talking about 50-year-olds.
Absolutely. Yeah.
So today's episode came off a Instagram reel that my side piece podcast host, Luke Chemies, sent me, talking about whether somebody should buy a house at 50. And the idea was some kids are flagged going, my parents have a little bit of money in KiwiSaver, nothing else. And they're thinking about buying a house with it. And I'm worried whether that is the right thing or not.
Yeah.
And I jumped on the old Instagram reel, did a little TikTok, as the kids do. Little dance.
Did you just dab? Don't.
One more time? One more.
Don't. Georgia's like, stop.
Georgia could turn that into like a GIF or something. And I responded and I was like, look, this is probably a bad idea. And there are quite a few comments back being like, screw you, James. So I thought we'd run into the numbers.
Yeah.
So today we're going to run through two scenarios, whether you're in this situation or maybe you're thinking about your parents or somebody else you know. I think it's quite a relevant topic. Mike, the question is, financially, if I show you the projections and I go, this is a bad idea to buy a house at 50, why do people still want to do it?
Well, screw you, James. No, look, there's a number of reasons why people buy property. It's not always the right thing to do. And that's coming from a mortgage broker, right? I have a vested interest in you buying a property.
Love to give people debt.
Yeah, it's basically, there's a number of reasons. One, security. You are more secure in your own home. You're not going to get kicked out. Tenancy's not going to end. You're not going to get a flat inspection every 2 or 3 months or whatever the cadence is. Two, social pressures, right? A sign of success in New Zealand is buying your own house, right? Having your white picket fence or whatever color you choose to paint it. And that is actually a huge reason why people buy property and why people buy houses and not apartments and not other things and not the S&P 500. It is the social pressure of I've done the right thing, right? And we talked to Reagan about this from Where's My Money. He did all the right things socially, got the girl, got the house, had the kids, upgraded the house, and that's where he got tripped up.
7% interest rates will humble us all, Michael.
Yeah, 100%. And then the other reason, I guess, is people just generally think it's the right thing to do. They see it's worked for everyone else around them and they go, hey, it's worked for everyone else. Why would it not work for me?
Yeah. My concern in this situation, if you go, let's say you're going to buy, I don't know, an $800,000 house and go between you and your spouse, you've got $80,000 in KiwiSaver, and that's all you've got to show for your situation.
Yeah.
Then you've got a $720,000 mortgage. You've got 15 to 20 years to pay it off. And then once you've paid it off, you still have no assets. So you might not have rent, but you don't have any investments that when you stop working outside of New Zealand superannuation, you're going to be able to have a regular income in retirement.
Yeah.
And that's my big concern.
And one of the ways that you can get around this problem and probably think about it a little bit differently is to outsource the thinking, right? To have a financial plan and get some projections. So, James, run me through the numbers. What does it look like if someone buys a house at 50?
Yeah. So, there's so many different assumptions you can make, but I've run through a scenario where somebody continues to rent long-term versus they buy a home. Let me just say, if we're talking about buying an $800,000 home, I have tried my best to make this work in terms of really either scenario. And that's probably the slightly grim part about this. And I would definitely say the best time to start was yesterday. The second best time to start is today. And there is definitely things you can do to improve your situation. But a lot of these projections don't look good either way, which is the lesson around how you need to start thinking about these things and start planning for your future early.
Yeah.
I have done a scenario where they buy a house for $800,000. They have a $720,000 mortgage. They have no other investments because they've used it all for the 10% deposit. So they're mortgage repayments at a 6% interest rate, because I've tried to be a little bit generous, going like, we're heading in a good direction.
Yep.
$4,400 a month. I've assumed their incomes are $110,000 each. Now you might go, James, they are high incomes. It's the only way I can get these projections to work at all.
Yep.
And then I have assumed their expenses, excluding the mortgage repayments, are $5,000 a month, which you just think about the cost of food, you add some bills, that's a lot.
That's not much, yeah.
In that situation, it still takes them until 62 to pay off their mortgage. And I really don't think this scenario is that realistic, because it's assuming so many different things. So the idea of having to knock through that mortgage over that period of time. Now you could argue, you wait a few years, the value of the property goes up, the debt goes down, you buy an investment property. We're talking about somebody taking on more debt in their late 50s.
Yeah, the issue is you're going to have the age and stage of the customer, even with a reasonably high income. Banks are going to be very reluctant to keep leveraging them up because they're looking at it the same way you look at it, right? And I think people often forget that about banks is they go, can I get the numbers to work on the calculator? Yes, the bank should give me the money. That's not how banks work, right? You fail to take in the rest of the risk of the deal. And if I was a banker and someone's 60, because what you've done there is you've calculated it on a 10% deposit, which means they're high LVR. So their interest rate's actually going to be higher than that. You're probably looking like 6.75, 6.5, 6.25, somewhere around there. It's going to take them longer to get 20% equity. And then they have to get enough equity to go purchase again. You're probably looking like 7 years in. So 57, 56, you're telling me to give someone an investment property at 100% debt when they've reasonably only got, 10 years left to work, if that. That's not a good proposition for a banker.
Now, Mike, let's talk about what happens in terms of the mortgage application. So if you or I get a mortgage, we're young bucks. We've got lots of time ahead of us. So the Botox says.
Yeah.
If a 50-year-old comes to you, do they get a 30-year mortgage, or are we talking about a shorter period?
Usually it's a shorter mortgage, yeah. You're a 50-year-old, you're looking, unless there is, so in the scenario you've given me, it's high LVR. There's no way you can give a high LVR loan out or responsibly give a high LVR loan out and be pushing that through to 72 or 70, something like that. If it's high LVR, you have to be able to pay it off in at least 15, 20 years, right?
Because I know you've taught me that the banks always think about how am I going to get my money back, right? Yeah. And if we're creating a story where you're still going to be getting your money back in your 70s and it's not an investment property, it's where they're living, that doesn't fly, does it?
No, it doesn't. And at the end of the day, the bank just wants to know, can you pay it off in time? What's the risk of you not paying it off in time? What happens if it all goes wrong, right? And no banker wants to be the person that is kicking a 67-year-old out of their house because they can't pay their mortgage. Because something you got to remember, as you get older, you're more likely to get sick, you're more likely to get injured, and things go wrong, which means you can't work. So I know you're like, most people are like, oh, well, I could work, until I'm 70 because that's the type of job I have. You absolutely may be able to do that. However, the risk of you not being able to work later in life significantly increases. And that's why the banks are reluctant to do this, right? And to be honest, fair enough. You don't want to be the 60s, the banker kicking a 69-year-old out going, sorry, Bob, we've got to sell the house and have fun on the streets,
Yep. The bank does not want to be that person anymore. Before we move on, we talk all the time about planning and growing our wealth, but protecting that wealth is just as important. That's why having the right insurance in place can help when life goes unexpectedly.
And that's why this episode is brought to you by Partners Life, a New Zealand-operated, award-winning insurance provider with over 300,000 Kiwis insured and 89% of claims paid.
Partners Life understand that having some insurance is better than having no insurance. They have flexible and personalized solutions for any budget or situation.
Check out their website in our show notes below.
So if we run into the projections a little bit more, so they've paid off the mortgage in 12 years, then they are starting to save for retirement. So at 62, we go, all right, mortgage is gone. We're now in a position where we don't have those $4,000 a month in repayments. We can put some money towards, an investment like a managed fund or whatever it might be. If we build that up till 65, we've got $548,000, including KiwiSaver. And the KiwiSavers, because they've drained them out, are roughly about $120,000, $130,000 each.
Yeah.
Now, they run out of money at about 82, which is not where I want people to be. We want their projections to be heading probably to about 90.
Yep.
Is where we want to head. Now, if you're Michael Vincent,
I've got 2 years spare there.
Yeah, if I can get the projections to work to about 40,
Yeah.
it's about 3 years past life expectancy. So we're pretty happy in that sort of scenario. So that is the buying a home scenario.
Yep.
Now, the other question is, should they just keep renting? The other thing in here as well, right, is we're talking about the math, the numbers. There's the psychological element to all of this, and is history an indication of the future? So we've got a 50-year-old. Now, who knows what's happened in their life, but they've got pretty much $80,000 in KiwiSaver to show their name. They have no history of savings. So I think it is a very relevant point to go, all right, well, we're saying they should continue to rent and save and invest this money, but they have no history of doing it. Versus those who will be an advocate for the mortgage, going, well, it's forced mortgage repayments. They are continuing to like save and pay down some debt and grow some equity.
Yeah, and a lot of people are in different situations, and we see relationship splits, later in life as really can set you back to square one, and trying to rebuild after that can often be pretty challenging, especially for people who don't have a lot of capacity to increase their income, or for those who haven't been working and are re-entering the workforce. That can be really tough. So everyone's situation is different, but looking at the math, that's a pretty bleak kind of projection.
Okay, well, let's move on to the scenario where they rent. Let's talk through some of these projections. If you're just watching the audio, we have some projections up. You might want to check out the video. So in this scenario, we are continuing to rent. It's the same income, the same amount in KiwiSaver. Instead, they're not taking the money out. And we've got them with rent of $600 a week is what I've plugged in there. Do you think that's a fair
I'd say so.
number? I mean, obviously depends where you're living in the country. 1,000 different iterations of all of this. So they're pretty much able to save about $5,000 a month based off the same budget and their rent. Now, very valid point going, history doesn't indicate that they're able to save over $1,000 a week going forward, but this is just based off the math. So if they save that money and kind of built it up over time, they've got about $1.35 million come 65, instead of in the previous scenario, $500,000, but a debt-free home.
Yeah.
The benefit of this scenario is they've got more cash, more investments. The downside is they've got an additional cost running through retirement. They've got a lack of security. They're probably going to get moved around. People sell their homes at some point. Now, when you continue to take into consideration the rent continuing to come out over time, they still erode their money at probably about 86. So not a hell of a lot better than that other scenario.
Yeah.
Which was my point around going, this is pretty tough either way. What do you think of those numbers, Mike?
Yeah, I mean, they're both pretty similar projections. And again, it really just highlights the fact of if you start early, you have to make less sacrifice. And, they might be looking at other ways to kind of improve that situation. Perhaps they buy a home and rent it out. I know they just have their KiwiSavers, so you got to stay in the house for 6 months. You might be moving in with friends to reduce that that rental payment. There's a number of different things you can look at, but either way, the sacrifices you have to make are so much bigger because you're starting later in life.
Yeah, so if we look at the numbers, they're probably slightly better off continuing to rent than they are to buy a home. But I would just want to stress, it depends the value of the home you're going to buy, your income, your expenses, and whether you can actually stick to a plan and implement it over time, which history would say maybe these people have struggled to do.
Yeah.
The other thing I want to talk about is the cultural element to this as well, which we haven't spoken about. So we might go, this doesn't make any sense, but I do know there are families out there that will go, I'm going to buy a home, my kids are going to live with me, then they are going to take over the mortgage in the future. Have you run into mortgage applications like that?
Yeah, we get that quite a bit. And different communities are more prone to doing that. And it's so different for the parents than it is for the kids. Reasonably speaking, because the parents don't expect to move out of the home, right? The kids, let's say there's 3 kids and they're all reasonably young. Maybe the oldest one has a partner, so they live in the house, and the other two live in the house, and they get a big enough house that they all live in there. As the kids get partners, they want to move out, and that causes huge issues because they want to go buy a house. Their partner's like, well, why can't we buy a house? And they're like, oh, I'm stuck in this thing with my family, and for me to get out of it means I have to kick my parents out of the family home so I can get off the mortgage. What usually happens is that one of them can get off the mortgage and the youngest one is stuck on the mortgage as well. Because the middle child wants to go, cool, I'm going to go grab a house with my partner. We can get one off and then the other two are stuck on. So that's usually what happens. So it causes some huge issues with the family.
Yeah. Coming back to the like the cultural element of it though as well. Like, say, I know Ravi's like long-term goal is to have like a compound where like his whole family lives there, his parents live there. I think it was an archery range in there as well. A lot of things moving, but like that's his like long-term goal is to be able to have his parents living with him and to be able to look after him. So it probably is a case by case basis, but you're right. It does make it hard to run your own race if it's all very...
It is, but like if you look at Ravi's situation, Ravi's not 50. Ravi's not relying. His parents have a house. They're not. He's not relying on this to come and save the day.
Very good point.
And that's the difference there. And a lot of times people don't fully consider the implications long term on their situation. And that's a very difficult conversation to have when your parents are like, hey, I want some security. We can all do this together. And, you know, if half the family's on the page and the other couple aren't, like, that's a very tough conversation to have. But, you know, it can really impact people's future.
Yeah. So, I mean, coming back to the, you know, this whole buying a house at 50 thing, the reality is this is tough stuff. Like, this is not, you know, if you're the kids, you're looking at it and go, my parents aren't secure about their future. That doesn't make me feel great. We're running through these projections. Neither look particularly good, which I'm going to be honest is not that surprising. We will pop the link in to check out the episode we did where we're talking about how to talk to your parents if they're behind financially.
Mm-hmm.
I think there's some really good sort of discussion points in there. The other piece I'd say is probably a couple of learnings. One is if you are younger, you do not want to be in this position. So if you've been a little bit kind of just going with the flow around your finances, those sort of things, this is your sign to take control of your finances, to make sure you've got a plan, working out where you are going to go and knocking out those goals. If you are listening to this and you are in this situation where you are renting, maybe you're close to 50 and you go, oh, these numbers are dreadful. I'm feeling bad about my future. One size does not fit all. I've done plans for 60-year-olds where we've got them financially free by, 67. Now, granted, they had strong incomes, but everybody's situation is different and you can do something to get yourself in a better situation than you are today. So please do not take these projections as gospel. Think about your own situation and focus on how you can get ahead.
Yeah, 100%.
Okay, thank you very much for joining us for this episode. Much love to Partners Life. Please make sure to subscribe to our YouTube channel, which is building a hell of a lot of momentum at the moment. Please make sure to give us a review on Spotify, a like, and we will catch you next time.
Cheers.